What is going on, guys? It is Ahmed, and I am back today with yet another video for you all. And today we're going to actually talk about something a little different. So I'm a person who really likes to go on Reddit and read Reddit posts, etc. And they have the r/stocks, so Reddit/stocks, forum where you can just go on and pretty much say whatever you want to talk, anything to do with stocks, basically. So what I want to do today is I want to address one of these posts that I saw that was posted earlier this morning, because I thought it could resonate with all of us. A lot of people are out there saying, we are about to enter in a bear market. The market is overvalued. The market is overhyped. And there's always going to be people like that on the internet. There's going to be analysts like that in Wall Street. There's going to be people like that, news anchors on certain news stations, news channels. But for the rest of us, the ones who aren't influenced by a single person, rather doing our own due diligence, our own research, this is not a bad thing to, use as a potential resource. Reddit, just to see what other people might be thinking as well. Because like-minded, myself, I believe that, yes, sure, a pullback might happen, but the only people who actually truly lose money are those who sell when the overall market pulls back or when a dip happens, the panic sellers, right? And those are people potentially putting too much money into the market that they're not comfortable losing. And again, I addressed this so many different times. When I say losing money in the market, I mean not actually losing money, but rather seeing your portfolio turn red and pull back, which is something I want to talk about later, because a lot of people are seeing red portfolios, although we're currently in a bull market, right? The market overall did have a pretty bad pullback, for about a month or so during February, March, but now we're back to all-time highs when it comes to the S&P 500. So let's look at this post here on Reddit. So the S&P 500 will hit 10,000 before the end of the decade. Just so you're all aware, currently the S&P is sitting at 4,128. So it's saying potentially going to double, more than double, pretty much 2.5 times its current value by the end of the decade in the next 9 years. I think this is actually very, very sensible and a pretty good guesstimate when it comes to looking at the outlook of the market. If we go back and just kind of draft what happens every 5 years in the market, pretty much close to doubles, more like every 7 years. So in the next 9 years, potentially, I could see the market going to 10,000. So what does this person write? Sounds pretty nuts, right? If you invest in the stock market, you see the bear posts, because pessimism sounds oh so smart. It does. It's very, very, attractive to see something that gives us this, psychological fear, which ends up causing us to potentially sell out of our positions at times that we really shouldn't have. Because if we would have waited another week, another month, boom, we see exponential gains right after, typically from a severe pullback. So there will be no shortage of market crashing incoming and people waiting on the sidelines because of the crash scare. Here, the Dow Jones tripled over the last 10 years. No one will make posts about back in 2011 saying, I think by 2021 we will see the Dow Jones at 30,000. If they do, people will think they're literally nuts. 100% agreed. Very well said. On the other hand, S&P 500 going to 10,000 is in fact not that big of a deal. At current level of 4,000, it annualizes about a 9.5% return. Pretty accurate. This is in line with how the S&P 500 has performed over the years. All right. When businesses keep growing and stocks keep pushing all-time highs, there will always be people saying that the market is crashing soon along the way. Invest accordingly, as he states, something that I say all the time. Don't invest in money that you can't lose. With that being said, the psychological aspect of it, folks, it's not the fact that you're going to actually lose money, but being able to stomach and handle a red portfolio, an overall 10%, 20, 30% potential pullback, and not have that FUD or fear, uncertainty, and doubt where you end up having to sell, and rather have those diamond hands be able to hold on tight to your shares. Don't use margin if you're unable to, pay off that margin. Just like, again, you don't want to have debt anytime, anywhere. If you can go without it, look at the Dave Ramsey philosophy. Try to stay away from debt when you can. Set aside your emergency fund. 3 months. I always say, something that I preach to all my friends, my family, myself, first and foremost, is keep 3 months on hand of money, where if you lose your job or if you're unable to, just make ends meet for whatever reason, right? You just need to have about 3 months worth of an emergency fund set aside so you could be able to provide for yourself, your family, first and foremost. And then when you see a red portfolio, you won't be tempted to sell out your position, because you're going to think, hey, I'm not going to be able to pay mortgage next month, my rent next month, my car, whatever it might be. Buy index funds or great companies that you know and you believe in. We say that all the time, whether they're a penny stock that you believe in them long term because you want to be an earlier adopter, or some of those big growth stocks. The hardest part is sitting tight. Beautifully said. I love this post, and that's why I think it has so much upvotes, is because it was so well said and I couldn't say it any better. Now, before I continue the video, I want to mention, for anybody that is looking to get free money, no strings attached. All you got to do is go on Webull, click the link below. Between now and the end of April, you can get one free stock for just opening up a brokerage with Webull, value between $250 and $250. And then if you make an initial deposit where you put in $100, into your Webull brokerage account, you get a free stock valued between $8 and $1,600. No strings attached. Now, say you go on Webull and you don't enjoy the app, you could take your money, pull it all out, take your free stocks, pull it out as cash, and go about your life, go back to your brokerage. But I think you might actually think that Webull is pretty decent. I love the brokerage. It's my day trading account. It's my account that I use for buys and sells, one that I will look at on a day-to-day basis. I do have other brokerages that I use as well, TD Ameritrade, even Robinhood. But Webull is my main one when it comes to my more speculative plays, things like that I'm looking at more actively, because they have some fantastic charts and things available as well. So go ahead and get your 2 free stocks, folks. Now, the S&P 500. Historically speaking, this is kind of the reason that I love the S&P 500 is it kind of tells us, it's SPY. It's the overall market conditions. This is kind of what is telling us, what is happening with the general market, around the entire United States. So currently, as you can see, just based off the max chart, I'm looking at this is the Google very simplified chart. You can see what typically happens. The stock market goes up, 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 up. We see a pullback, up, 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 another pullback. It's a very constant and steady rotation, right? Very, very constant and steady, except since 2008 after the big crash. Since then, we've seen miniature pullbacks, nothing too significant, all the way till 2020, up 373% in just about 11 years, right? A little less than that. And then, of course, COVID happened and, the pandemic occurred. And then we saw an overall market pullback. It was a pretty significant pullback, the worst we've seen in a really long time. But immediately after, we went right back to the direction we were going prior to the pullback. So you could see it pretty much if you draw a line there. Let's just look at the 1 year. By now, it's a little more than 1 year. Let's just look at the maybe even 5 year. Yeah, you could see if you draw a line or a trajectory, you could see basically if you follow my cursor, it's going straight back to basically where it was, as if the pullback never occurred. So if we follow this line, that 10,000 where the S&P might be in the next 9 years, very, very possible, way up here. I know it's off the chart, but regardless, the reason I'm sharing this is because a lot of people have this fear, uncertainty, and doubt. FUD, 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 instead of being able to HODL or hold on for dear life, right? All these stock market terminologies. And if you're somebody, right, that has looked at your portfolio, including myself, and you realize, hey, why am I so red? The overall market is green. Why am I so red? That is just basically telling you you are not diversified enough, right? Diversification is key. What can you do to diversify your portfolio? Speculative plays are wonderful. Let's look at my 1K to 10K portfolio. Let me make my screen a little smaller so you guys can see better. Be a kind of a portfolio update, but look at my 1K to 10K challenge. This is a portfolio that is 150% speculative plays. We started with $1,000, down about $255 or so. In the last week, down about 6.7%. The S&P 500 in the last week, we'll just look at the 5-day, it's up about 2.3%. Had a really good week. But this is what happens when we're in very speculative plays. They don't necessarily follow the S&P 500 trajectory. Some stocks are up in this portfolio, some stocks are down. Now, if your portfolio looks like this and that is your main portfolio, you have a problem, a serious problem. That means you're not diversified enough. So what can you do? Quick solutions. Instead of focusing on solely speculative plays, remember, I always quote Warren Buffett. He said, the stock market is a vehicle to take money from the impatient to the patient. We know that is true. So holding is one of the big things we can do. In addition to that, He says if he can go back in time, right? I use him an example because he's such a guru in this space. But he says if I can go back in time and change one thing, I would buy more speculative stocks or more penny stocks. So these are fantastic things to be in. Invest into penny stocks, right? But if you see dramatic pullbacks in them because of volatility, right? Let's use Zomedica, for example, one I cover heavily on my channel. Cost average on this challenge, $2 a share, down 37.9%, right? On this portfolio. My main portfolio, my average is much lower because I did get in about 39 cents a share originally, sold out, etc. I was able to day trade a bit. But regardless, if we see some of these plays are down substantially, but what does that mean? If this is how your portfolio looks overall, when you see, a very red week, when it's an overall market green week, that means you are not diversified enough. So what is the solution? Buying into index funds, although lately, it's something that is kind of looked down upon. It's like, hey, you're taking the easy route out. If you want to do that, just make an IRA, forget it. No, diversifying with index funds is actually brilliant. Buying into the S&P 500, very, very smart, because when we do see pullbacks, generally speaking, right, they're a couple percent. And sure, you're not going to make those substantial gains that you might make with some of the speculative plays, but diversifying and allowing yourself to have a great big chunk of your portfolio into big companies, Microsoft, Facebook, big tech companies, and in addition, some of the others. There's a long list of what the Fortune 500 comprises, but again, doing so and diversifying your portfolio is going to allow you to continue to see green when some of your other stocks go red. If you're only in speculative pharmaceutical plays, right? If we look back here, like this portfolio is literally pretty much all pharma plays. If the sector gets hit hard, especially in the penny stock sector, healthcare sector, then my overall portfolio is going to look really bad. If the overall market for penny stocks in healthcare do well, my portfolio is going to look fantastic, but I'm not diversified enough. Sure, BHTG, bio-high-tech is not necessarily, that's more in the energy space. That is true. But again, overall, the other 7 or so companies are all healthcare, pharmaceutical companies. So not enough diversification for this challenge, which is okay because that's not the intention of this challenge. So make sure you understand that. But if you want to diversify, look at things like the S&P 500, VT, right? VT is Vanguard Total World Stock Index ETF. Having your money in ETFs is not a bad thing. ARK Invest, right? ARKG, ARKK, ARKX, whatever it might be. Look at ARK. Let's just look at ARKG stock, right? This is specifically genomics, which has, again, been hit pretty hard. But if you look at the 1 year, look where it was April 2020. Look where it is today, up 161%. So diversifying by having ETFs as part of your portfolio is a very healthy thing to do. Comprised of about, between 60 to 80%, or select stocks within these ETFs that you believe in that are, again, big, high market cap, high market value companies that you're willing to put your money into because you believe in them, not for the short term, but rather for the long term. And these are the kind of things I want to start introducing in the channel. I do love penny stocks and I'll continue to cover them because I truly think some of these have the biggest potential for gains. Again, we can just pull up quickly. Zomedica, one of our personal favorites. Yes, it's had a very, very, very terrible last month since news came out, down 50%. But if we look at the 1 year, look at this. Still up 1,100%. You can't see that in you can't see that in the S&P 500. There's no way. No company will make those kind of gains if it has such a big market cap. But no company typically in the S&P 500 will pull back this heavily either. High risk, high reward. So understand that very well, embrace that information, and do what you got to do with it. So why am I saying this? Why am I bringing all of this stuff up? Excuse me, little word vomit there, trying to say too much too quick. But basically, again, everyone, I'm mentioning this because I truly believe in diversification. I believe in just making sure that your portfolio overall has, substantial gains, but within that, having things that are, things you can hold for a decade, 2, 3, 4, 5 decades. Like, again, look at the Vanguard. Look how long it's been around. Look back at 2008, $49 a share. Sure, up 100%. But again, that's kind of almost like a guaranteed money for you for the long term. It even has a dividend payout of 1.32%, and they have been paying this out. So when a stock has a dividend, you're guaranteed, this much money per year, 1.32%, probably split up in either 6 or quarterly, 4 times a year. So guys, Thank you so much for tuning in. I really do enjoy making these videos. A little long today, but I did want to give everyone an update on, especially if your portfolio has been looking red, some strategies and ways to kind of, decrease your risk and increase your potential gains over time. So until next time, everybody, keep investing.